Repo market oversubscribed. Fed loses control again. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over the numbers. Yesterday, the term repos, the Fed was offering up $20 billion and there was $70 billion in demand, over $50 billion oversubscribed on the term repos. The overnight repos, $100 billion, $108 billion of demand. So not as much oversubscribed, but the amount of overnight repos is going up dramatically. Because of that excess demand, the repo rate spiked up to 1.8%. And I saw on Twitter yesterday that a lot of the CNBC analysts were saying the reason the Fed might have cut rates down by 50 basis points was because of the repo market pressures, and that 50 basis point cut would relieve some of those pressures. Well, on Twitter yesterday, a couple of people asked me this directly, and I responded by saying that I didn't think that the interest rate drop would relieve any of the pressures on the repo market. And that's due to my conversation with Jeff Snyder. So what happened this morning in the repo market? Well, it is officially stiff drink time, because even though the Fed dropped interest rates by 50 basis points, again this morning it was oversubscribed. The overnight repos, the Fed was offering $100 billion, but there was 111 in demand. So even though they dropped 50 basis points, that still didn't fix or even help the repo market at all, just like I predicted last night on Twitter. Step number 2, how it works. There's a lot of confusion that I see in the comments and on Twitter about the Fed injecting money into the system. That's what you always hear, and it's not exactly true. There's a lot of nuance to this that people just don't understand. So I'm going to get you up to speed right now. The Federal Reserve's balance sheet has assets and liabilities. On the asset side, usually treasuries, mortgage-backed securities. On the liability side, those are the deposits from the banks under the Fed's umbrella, typically the primary dealer banks. That's where they keep their reserves. So those cash reserves are a liability on the Fed's balance sheet, just like customer deposits are a liability on a normal bank's balance sheet. Moving over to our primary dealer banks on the asset side of their balance sheet, treasuries and those reserves. Also liabilities, like we just said, customer deposits. And I know these are very simple balance sheet, guys. On the comments last time, someone said, oh, that's not what a bank's balance sheet looks like. It's far more complex. Yeah, I get it. But right now, I'm just trying to explain the basics. So this is applicable for what we're trying to achieve today. So treasuries, reserves, deposits, same thing for Bank B. We go over to the hedge funds. We're just going to focus on the asset side of their balance sheet. That would be the deposits that are liabilities of the banks. And in this case, they've got some treasuries. In our first example transaction, the Fed does a repo with primary dealer bank A. That bank gives the Fed those treasuries as collateral. They go onto the Fed's balance sheet, and the Fed puts more reserves into the account of that primary dealer bank. So the way that the balance sheet changes, on the asset side, the Fed has more treasuries, and then on the liability side, primary dealer bank has more reserves than they had before. So what does that do to primary dealer bank A's balance sheet? Well, instead of having those treasuries on the asset side, now they have all reserves, and the deposits or the liabilities don't change at all. So if we had $1,000 of deposits to start, we still have the same amount of deposits. That is crucial that you understand that. Because when we talk about money getting into the system, if money is on the Fed's balance sheet in the form of reserves, it is not in the system. The only way there can be additional funds over on this side is if the actual deposits increase. So if the transaction is exclusively between the Fed and the primary dealer bank, it doesn't increase the amount of liquidity that we have in the actual system itself. In the example repo transaction number 2, between primary dealer bank A and a hedge fund, the hedge fund will assume has an account with the primary dealer bank. That's very important, and we'll get into that in just a moment. The treasuries go from the hedge fund to the bank. This increases the size of their balance sheet. They have the same amount of reserves, but more treasuries. Also increases the liability side in the sense that they now gave that hedge fund an additional $250, we'll call it, for that collateral. So the assets on the hedge fund's balance sheet, of course, increase by that same $250. That means that they have additional purchasing power. That is key. In example number 1, we didn't change the amount of deposits in the system. That means we didn't change the amount of purchasing power. But in this example, we've gone from $1,000 of deposits to $1,250 in deposits. So because this transaction was between a primary dealer bank and another entity in the private sector, yes, in this case, we do have more money injected into the system. Example, repo transaction number 3 between Bank A and the hedge fund, but this time the hedge fund has an account with a different bank. The hedge fund still sends the treasuries to Bank A. They go on the asset side of Bank A's balance sheet, but the size of their overall balance sheet does not change. They have fewer reserves. Now they owe those reserves to Bank B because that's where the $250 deposit is for the hedge fund. But remember, this all happens on the back end because their reserve accounts are with the Fed. So the way this looks is the Fed takes reserves from Bank A's account and just sends them into Bank B's account. It all happens on the back end. Really, the only thing that happens on the front end is the $250 deposit is created with Bank B and the treasuries go to the asset side of Bank A's balance sheet. In example transaction number 4, between the hedge fund and our new participant, stock seller Steve. The hedge fund goes over to Steve and says, listen, we've got a deal for you. We want to buy $250 of your shares. Steve looks at the hedge fund and says, oh, I don't know. You guys seem a little sketchy, but we'll go ahead and do the deal. So the transaction starts with Steve having $250 of shares as assets. The hedge fund has $250 of deposits with their bank, Bank B. We'll assume that Steve banks with Bank A. After the transaction is done, Steve now has $250 of deposits. The hedge fund has those $250 of shares, and the deposits and the reserves go from Bank B just over to Bank A. And on the back end, remember, the Fed simply takes the reserves from Bank B and puts it into Bank A's account for $250. So the main takeaway from step number 2 is all the transactions we see on the New York Fed's website, the repo operations, are between the Fed and the primary dealers. That means that there's no additional deposits that are being created unless the commercial banks do so themselves. So the Fed could take their balance sheet up to $100 trillion and it wouldn't matter. It doesn't mean that that liquidity is getting into the system. The commercial banks have to take that additional liquidity or additional reserves and turn those into more deposits. Then the people or the entities that have those additional deposits can take them and buy shares in the stock market, bonds, XYZ asset class. But the whole point is to remember that the Fed actually has very little control over the amount of liquidity in the system. The entities that have total control over that are the primary dealers and the commercial banks. Step number 3. Why are the Fed's repo operations oversubscribed? What you hear in the media nonstop is there's a lack of liquidity or lack of reserves. That doesn't make a lot of sense because if you look at the Fed's balance sheet, the liability side, we know there's 1.5 trillion in excess reserves. And for those of you who haven't seen a lot of my videos, I'll fill you in on a little surprise. Before the GFC, generally there'd be about 6 or 7 billion with a B in excess reserves. Now there is 1.5 trillion with a T in excess reserves. So I have a hard time believing that that is the root of the problem. They say also, well, the regulations with Basel III and with the GSIB, also the LCR, which is the liquidity coverage ratio, that makes them hold more reserves. Yeah, but does it make them hold 1.5 trillion? I don't think so. Also the deficit. People say, well, the government's been selling all of these bonds because Trump's running these $1 trillion plus deficits, and the primary dealers are responsible for buying those bonds, those treasuries. They're the market makers. Well, that may be true, but if the primary dealers are buying all those treasuries from the government, that still depletes the excess reserves because the Treasury has the TGA, the Treasury General Account, which is a completely separate account with the Fed. I've also been hearing in the media a lot lately that these oversubscriptions could be a result of the cerveza sickness, and the banks are really getting freaked out, so they're trying to increase their levels of liquidity. Well, that doesn't make sense either because the huge oversubscribed repos were yesterday, which is March 3rd. So why, if the banks wanted more liquidity because of the cerveza sickness, would they just start March 3rd when last week the market went down by 12% because of that same reason? Or it could be a collateral issue, which I think is far more likely. The way that would play out, Bank C needs some cash, but unfortunately, they don't have any pristine collateral, which, believe it or not, the market considers to be treasuries. All they have are subprime auto loans. Bank C calls up their buddies at Bank B and says, listen guys, we've got a little problem. We need cash. We don't have treasuries. Let's do a little swap really quick. The guys at Bank B say, yeah, fine, okay, whatever. So they swap that collateral. Bank C takes the treasuries and goes right to the Fed. The Fed has no idea that those treasuries are backed by subprime auto loans. They take the treasuries, they give Bank C the reserves that they need. Bank C is free and clear. They are good to go. If this happens in mass, in aggregate total, throughout the entire banking system, where they have a lot more of this garbage collateral, that would force more of the banks to go to the Fed and get their repo transactions done there, creating an oversubscription. Really what it boils down to is the Fed would be the only one that was stupid enough to take that collateral that really wasn't the bank's to begin with. Number 3 is counterparty risk. This is pretty straightforward. Bank A is almost insolvent. B and C know that well. So if the Fed wasn't involved, Bank A would have to go to the other banks and say, listen guys, we need cash. they would say, no way, we're not taking the risk. They'd basically give them the Heisman. So Bank A has to go to the Fed because the Fed doesn't have to worry about profit or loss. So Bank A gives them the treasuries they do have. They get the liquidity from the Federal Reserve. For the moment, problem is solved. And you may be saying to yourself, yeah, George, I get it, but a couple banks running into problems, is that really going to create the oversubscribed repo operations that we've been seeing lately? What I need to remind you is that the repo market is much greater in size than what we see with the New York Fed's website. It's $1 to $2.2 trillion of transactions every single day. So even if a small fraction of those transactions are having problems, that is going to lead to the Fed's repo operations being massively oversubscribed. And what I've been saying in the last few videos is it's really about the Federal Reserve and the government versus reality. They are in this battle for confidence, whether it's consumer confidence, confidence that the stock market will always go up, or confidence in the $2.2 trillion a night repo market. And if the Fed and the government lose the battle of confidence, that last Jenga piece goes, then it is really stiff drink time. For more content that'll help you build wealth and thrive in a world of out of control central banks and big governments, check out this playlist right here. I will see you on the next video.